Hello, and welcome to the program on WHEDA Tax Advantage, commonly referred to as Mortgage Credit Certificate Program, or MCC. Let's begin with a little background information about the Mortgage Credit Certificate Program. Mortgage credit certificates were authorized by Congress in 1984. This exclusive program is based on WHEDA's allocation of mortgage revenue bonds. When approved to use a mortgage credit certificate, the borrower reduces their federal income tax liability for as long as they meet specific requirements. MCCs are an exclusive WHEDA offering, reducing the amount of federal income taxes paid by your borrower. Eligible borrowers can subtract up to 40% of their annual mortgage loan interest from their federal income tax due for up to 30 years. The maximum annual credit is $2,000. The average savings for borrowers is $1,500 per year. In order to receive this credit, the borrower must meet some qualifying requirements and pay a relatively small upfront fee. The credit can be used for the life of the mortgage, typically 30 years, as long as the property remains the borrower's primary residence. Working with our lending partners, WHEDA has successfully issued 339 MCCs in 2015. Next, we will cover the eligibility requirements for MCCs. To be eligible for a MCC, borrowers must be a first-time homebuyer, an eligible veteran, or purchase a property in a designated target area. A first-time homebuyer, as defined by the IRS, is one who has not owned a principal residence within the previous 3 years. There are 2 exceptions for this guideline. The first exception is a qualified veteran who must provide a DD-214 reflecting an honorable discharge. The second exception is if the purchase of the home falls within a federally designated target area. MCC eligibility also requires the borrower to purchase a home that does not exceed MCC income and purchase price limits in their county. These limits, set by HUD and the IRS, are listed by county. Please be aware that designated target areas may have their own income and purchase price limits. Income limits are adjusted for family size and must include all income from all adults intending to occupy the home. This is called compliance income and must include any overtime, bonus, commission, and tips in addition to an individual's regular pay or salary, self-employment income, child support, alimony, rental income, and even potential income from use of the MCC. You should include all sources of income, even if there is no guarantee that that income will continue. In addition, the borrower must be current in child support, birthing expenses, and maintenance documented through the Wisconsin Child Support Lien Docket. To document compliance income, you must obtain 2 years of federal tax transcripts, their corresponding W-2s, and current pay stubs. You may also need to obtain verification of employment for all previous employment. To help you determine compliance income, please use WHEDA Form 29 and send it to a WHEDA underwriter for review. It is important to note that compliance income may not be the same as the income that is used in the credit qualifying decision. The limits and additional information can be found in the Single Family Toolkit on www.wheda.com. Be sure to use the tax advantage and first-time homebuyer limits. Now let's discuss property eligibility. The property being purchased must also meet certain requirements for the borrower to receive an MCC. First and foremost, the borrower must be purchasing a principal residence that will be owner-occupied. Second, there are certain types of properties eligible for an MCC, and they are existing single-family homes, condos, 2 to 4 unit properties that are at least 5 years old, new construction if the property is complete and the borrower is requesting permanent financing, and acquisition rehabilitation. It is important to remember that no more than 15% of the property can be used for business or income purposes. Finally, there are certain properties that are not eligible for MCCs and include manufactured homes, commercial properties, and timeshare units. In addition to eligibility requirements for the borrower, there are also minimum qualifying guidelines to obtain an MCC. All first-time homebuyers are required to complete an approved homebuyer education program conducted by a HUD-approved counseling agency, mortgage insurance provider, or through an approved online program. Borrowers must also have a minimum credit score of 620. There is an upfront fee for the MCC, which is dependent on whether the first mortgage is a WHEDA loan or a non-WHEDA loan. Borrowers obtaining a WHEDA loan for the first mortgage receive a reduced fee of $150. If the borrower has a non-WHEDA first mortgage, the fee is $600. Finally, it is important to remember that MCC applications must be approved by WHEDA prior to closing. The process to reserve an MCC for your borrower will be discussed later in this presentation. So far, we have discussed eligibility requirements for the borrower and property. let's take a look at the eligibility of mortgage products in the MCC program. As has been mentioned earlier in the presentation, a new MCC will only be issued in conjunction with the borrower purchasing a property that will be used as their primary residence. A refinance transaction is not eligible for an MCC. The mortgage must have a fixed rate of interest for the life of the loan and can be a WHEDA Advantage mortgage or a non-WHEDA mortgage. If using a WHEDA First mortgage, the MCC can be used under conventional or FHA pricing. However, the borrower cannot receive the benefit of the MCC and the special interest rate pricing available on the WHEDA First-Time Homebuyer or VALOR products. Non-WHEDA fixed-rate mortgages such as FHA, USDA, and Federal VA are acceptable. There are mortgage products that are not eligible in the MCC program, and they are as follows: adjustable rate mortgages, mortgages with balloon payments, interest-only mortgages, home improvement loans, high-cost or high-price mortgages, or mortgages financed through proceeds of qualified bonds or veterans mortgage bonds. Now that we have discussed the eligibility requirements for an MCC, let's go over the responsibilities of the borrower and the lender, along with some common questions that you may have regarding this topic. The borrower does have some responsibilities to ensure they get the maximum benefit from their mortgage credit certificate. Let's take a minute to review their responsibilities. First, the borrower must file all required tax forms when filing their federal income taxes each year. This includes a Form 1040, Schedule A, and Form 8396. It should be noted that the borrower will not be able to use short-form tax documents such as the 1040-EZ when filing an MCC. Next, the borrower must notify WHEDA within 1 year if they refinance their mortgage. In many cases, the MCC can be reissued. Borrowers should refer to Form MCC-011 for a list of required documentation. Finally, the borrower may adjust their W-4 withholdings with their employer based on the estimated monthly savings from the tax credit. If the homeowner needs assistance, the following resources are available: IRS Publication 530, Tax Information for First-Time Homebuyers, IRS Form 8828 and Instructions for Recapture Tax, and borrowers can also consult a tax professional. Let's discuss some of the responsibilities that fall on the lender. After originating an MCC, the lender has some small record-keeping responsibilities. Each year, near the end of January, WHEDA will provide a list of MCCs that your institution originated during that tax year. At that time, the lender will be required to confirm the accuracy of this report. In addition, the lender will be required to complete IRS Form 8329. This form must be completed to ensure that your borrower can take the advantage of the tax credit. The lender will send the original completed form to the IRS in addition to providing a copy to WHEDA. This form must be retained for 6 years. So what happens or needs to happen should a borrower refinance their mortgage? If a borrower refinances their mortgage, they must notify WHEDA within 1 year of the date of refinance. The MCC may be reissued if the following conditions are met. The borrower notifies WHEDA within 1 year of the refinance and requests a reissue. There is at least one common borrower that remains in the property as their primary residence. The originally purchased collateral remains the collateral. Next, in order to reissue the MCC, a $300 fee must be paid to WHEDA. Finally, the MCC will be reissued under the same terms as the original loan, meaning it will have the same end date as the original mortgage, as the MCC can only be used for up to 30 years. The MCC will be reissued based on the original mortgage amount, and the certificate rate remains the same at 25% or 40%. In what situation can the MCC be revoked? There are several situations in which the MCC may be revoked. First, if prior to closing it is discovered the borrower does not meet the qualifying requirements or materials they submitted were misstated or misrepresented. Another situation would be if the property is no longer the borrower's primary residence. Lastly, the MCC can be revoked if the borrower fails to notify WHEDA within 1 year of the date of refinance. Let's see an MCC in action. We are now ready to look at an example of how the MCC can save your borrower money. In the following case study, we have made some assumptions for this presentation. Remember, your borrower should always consult a tax professional for their specific situation. First, we will take a look at itemized deductions. Here's a Schedule A form listing the itemized deductions. In this situation, the individual paid $4,555 in mortgage interest in the tax year, with the total itemized deductions of $9,859. Here is the 1040 of a borrower who does not have the MCC. The total deductions listed are $9,859. We assumed a family size of 4 and the total taxes withheld were $4,740. Without MCC, they receive a federal tax refund of $544. Now let's see how the federal taxes would be affected if the same borrower received the MCC. Remember, to claim an MCC, the borrower must file IRS Form 8396 in addition to a 1040 and Schedule A. Here is the Form 8396. The mortgage interest paid is $4,555. The mortgage certificate rate is listed on the MCC. For first-time homebuyers, the rate is 25%. And for eligible veterans or those purchasing in a designated target area, the rate is 40%. To determine the mortgage credit certificate value, multiply the mortgage interest paid by the mortgage certificate percentage. In this instance, the mortgage credit certificate value, or mortgage tax credit, is $1,139. After we have determined the amount of the mortgage tax credit, we need to adjust our Schedule A. The borrower must reduce the amount of itemized deductions by the amount of the tax credit. In our case study, the borrower must reduce the mortgage interest of $4,555 by $1,139. This reduces the total itemized deductions to $8,720. Time to review the IRS Form 1040. As calculated on Schedule A, total deductions have been reduced to $8,720. We still have a family of 4. The tax due increases slightly due to the reduced itemized deductions. However, we then deducted the mortgage tax credit of $1,139 that we calculated on Form 8396. A total tax due of $3,230 was the result. This means the borrower will now receive a refund of $1,510. Next, we will compare page 2 of IRS Form 1040 with and without the MCC. The graphic on the left indicates no MCC was used, while the one on the right demonstrates the borrower taking advantage of the tax credit. The itemized deductions are reduced by the amount of the tax credit when using an MCC, so the total tax due increases slightly. Then you subtract any tax credits. In our case study, this is the mortgage tax credit of $1,139. Keep in mind, a tax credit reduces the total tax liability due. The result? A tax refund of $1,510 compared to $544. That's nearly a $1,000 difference. It's time now to take a look at how your borrower can claim their mortgage credit certificate at tax time. Many homeowners file an IRS Form 1040 with a Schedule A to itemize deductions. When using the MCC, the borrower will also need to file IRS Form 8396 with the 1040 and Schedule A forms. The MCC value is the percentage of the mortgage interest that is claimed each year. In Wisconsin, the options are 25% for first-time homebuyers throughout the state, or 40% for qualified veterans or properties purchased in a federally designated target area. As always, it is recommended the borrowers seek advice from a tax professional for their specific situation. Based on 2015 tax codes, here is some basic information about deductions. Standard deductions are set by the IRS and may be adjusted annually. Itemized deductions may include a total of medical expenses, taxes, mortgage interest, gifts, charitable contributions, eligible losses, and miscellaneous items paid through the tax year. Again, we recommend consulting with a tax professional to determine if any of these limits apply to itemized deductions. Let's take a closer look at the savings your borrower may realize with an MCC. This chart illustrates the potential value a mortgage credit certificate can have. For example, if your first-time homebuyer has been approved for a $100,000 fixed-rate mortgage loan with an interest rate of 4%, they can expect to pay approximately $3,600 in interest during the first year of homeownership. The corresponding MCC rate is 25%, which may make them eligible to receive a tax credit of $910. As previously mentioned earlier in this presentation, a qualified veteran or an individual purchasing a home in a designated target area would receive an MCC rate of 40%, resulting in a potential tax credit of $1,456. Remember, the maximum annual tax credit is $2,000. As we have seen in this presentation, the MCC can reduce a borrower's federal tax liability. Another benefit of the MCC is the money saved as a result of the tax credit, which can be used to help qualify a borrower for the mortgage obligation. For example, this chart indicates a first-time homebuyer obtaining a mortgage of $140,000 with a fixed interest rate of 4%. They can expect to pay approximately $5,000 in interest during the first year. For a first-time homebuyer in Wisconsin, the mortgage credit certificate rate is 25%, resulting in a potential mortgage tax credit of $1,274. To determine the potential income that can help qualify the borrower for this obligation, simply divide the tax credit of $1,274 by 12 months. The borrower will receive a recapture information booklet with their MCC after closing. Let's take a closer look to see when the recapture tax may be incurred. In order for the recapture tax to be applied, all of the following must occur. First, the home is sold within the first 9 years of ownership. Second, there is a large increase in household income, which is based on the adjusted gross income in the year of the sale of the home. And finally, there is a capital gain on the sale of the home. Remember, all three of these items must apply for a recapture tax to be incurred. Also, if the first mortgage is a WHEDA loan, WHEDA will reimburse the borrower. It's time to obtain the MCC. But how do we do that? Let's take a look at the steps to obtain an MCC. When your borrower applies for a fixed rate loan, you should review the application to determine MCC eligibility. If the borrower and property meet the eligibility requirements for MCC, the borrower should complete the required homebuyer education program and provide their income documentation. Once they have completed the education program and the appropriate documents have been received, the lender will prepare and submit the reservation package to WHEDA for a decision. A WHEDA underwriter will review the package, and if approved, a commitment or MCC reservation approval will be sent to the lender. Then the mortgage must close within the next 90 days, or the lender must notify WHEDA if otherwise. At closing, the lender will collect the appropriate fee and send a closing package to WHEDA, at which time a final review will be completed by WHEDA. Once all outstanding issues have been cleared, WHEDA will send the MCC and recapture information to the borrower, and a copy will be sent to the lender. Here is a list of all the required forms needed to obtain the MCC. All of these forms can be found on WHEDA.com. The reservation package checklist is used to reserve an MCC. We will discuss this checklist in additional detail shortly. The request for conditional commitment, recapture notice, and income tax affidavit must be signed by the borrower at the time of application and will be submitted with the reservation package. The closing package checklist must be submitted within 10 business days of closing. The lender, sellers, and closing affidavits must be signed by the appropriate party at closing and submitted with the closing package. The owner occupancy certificate is used to request a reissue of the MCC in a refinanced situation. The tax credit worksheet and schedule of fees are additional resources for you, the lender. The reservation package checklist, or Form MCC-001, is the first of the required documents needed to reserve MCC funds for your borrower. Remember, this document package must be received and approved prior to closing. The checklist was created to help you gather all the required documentation for requesting an MCC and should be used as stacking order when submitting your request. WHEDA created the MCC closing package checklist to help lenders submit the appropriate MCC closing documents. This checklist, along with all supporting documentation, must be submitted within 10 business days of closing. It can be found on WHEDA.com and should be used as stacking order when submitting the package. The lender must submit the closing package to WHEDA within 10 business days. Upon receipt of the package, WHEDA will complete a final review of the MCC documentation to ensure all required documentation as well as the applicable fees were collected. After all documentation has been verified, WHEDA will mail the MCC to the borrower, and a copy will be sent to the lender as well. In addition to the MCC, the borrower will also receive a recapture information booklet. This booklet contains information regarding potential recapture tax that may be incurred in certain situations when the home is sold. If the MCC is received in conjunction with a WHEDA first mortgage loan, WHEDA provides a recapture guarantee. This means WHEDA will reimburse any recapture tax that is incurred by the borrower. Remember, this guarantee is only available if the first mortgage is a WHEDA loan. Now that you have seen the benefits the MCC can provide to your borrower, let's discuss how you can become MCC certified. First, you must complete the training by watching this video. Once you have reviewed this training video, send an email to sf.quality.control@wheda.com to request the MCC post-training questionnaire. While waiting for the questionnaire, or if you need additional information, please review the Tax Advantage Origination Guide located on WHEDA.com. Then once it arrives, take the short questionnaire testing your knowledge of the MCC program, email it back to WHEDA for review. The WHEDA Quality Control staff will review your questionnaire, and if you score an 80% or higher, you will be MCC certified and ready to submit MCC packages for your borrowers. You are now ready to request the MCC post-training questionnaire. Email sf.quality.control@WHEDA.com to get the questionnaire. Remember to review the Tax Advantage Origination Guide on WHEDA.com for additional information. If you have questions, please contact us at 800-334-6873 and ask to speak with an underwriter or email underwriting@WHEDA.com. Thank you for joining us today. We appreciate your interest in the MCC program.